Hello students, good morning to all of you. Today we are going to learn working capital. So let us start. Introduction of working capital. So first clear the meaning concept of a working capital. Working capital is basically an indicator of short-term financial position of an organization. It is a short-term financial position of a business. So it is also a measure of its overall efficiency into the business. So the working capital is obtained by subtracting the current liabilities from the current assets. So it is simply formula that current assets minus current liabilities. This ratio indicates whether the company possesses sufficient assets to cover its short-term debts. Working capital indicates the liquidity levels of companies for managing day-to-day expenses and covers like inventories, cash, accounts receivables, and short-term debt that is due. So the working capital is derived companies' operations such as debt and inventories management, supplier payments, and the collection of revenues. So this is the main basic introduction of working capital. In that, working capital requires the two types of capital. First one is the fixed capital and another one is the working capital. Every organization, either commercial as well as the non-commercial, requires some amount of fixed assets for the procurement or for purchase, acquisition of fixed assets like land and building, plant and machineries, furniture and fixtures, vehicles. So in addition to fixed assets in an organization, they require the capital additional for financing day-to-day activities. So such a capital which is required for financing day-to-day activities is called as the working capital because it conducts the smooth flow of business. It's required for the smooth running of the business and the working capital which decides the success or the failure of an organization. Hence, it is also called as the lifeblood of an organization. So here simple the working capital means it requires the day-to-day activities for the smooth conduct of an business. So in a working capital requires two types of capital. First one is the fixed capital and another one is the working capital. Working capital management is clearly defined as, that is, it is refers to a cash, a business required for day-to operation activities, or more especially or financing the conversion of raw material into the finished goods, which the company sell for the payment. So simply is called as is refer a cash into a business they require to day-to-day operation for smooth conducting of business. So that financing which is related to the conversion of the goods, that is raw material, is converted into the semi-finished goods and the final output comes in, that is finished goods, where the company sells for the payment. Again here the definition is defined as working capital, the amounts fund necessary to cover the cost of the operating the administration, that is day-to-day operation activities and covered all the operation or the administrating activities. Next one is here the working capital is descriptive of the capital which is not fixed. But the more common use of the working capital is to consider, that is a difference between the book value of the current assets and the current liabilities. Here the working capital is descriptive, that the capital which is not fixed in nature. But here the capital where the business required for the day-to-day operations. So simply working capital is to consider, that is difference between current assets minus current liabilities. Okay. So the next question is the importance of the working capital. Importance of the working capital. Here are the some points which are related to the importance of working capital. First point is the smooth business operations. Smooth business operation. This is the key element of the working capital. Here the working capital, it means a lifeblood of a business organization, or it's also called as the nerve center of the business, which helps to maintain the firm as good well conditions and to operate a smooth conducting of the business activities. And now the second point is the regular supply of the raw material. In this, the regular supply of the raw material means the quick payment of credit purchase of the raw materials helps to ensure the regular supply of raw material and its continuous production from the suppliers. Third point is the easy obtaining loan. Easy obtaining loan means a firm which has a adequate working capital, which has a good solvency, high solvency, and a good credit ratings, can arrange the loans from banks and financial institutions in a very easy and the favorable terms. The next point is the enhanced goodwill. Enhanced goodwill means working capital is conducting or to operate a day-to-day activities in a smooth operations. So the sufficient working capitals enables a business concerned to make prompt payment and thus helps in creating and maintaining the goodwill because of all the current liabilities and operating expenses are paid on time. It creates the goodwill in the market. Next one is the strengthened solvency. Strengthened solvency means the working capital helps to operate the business smoothly without any financial problem for making the payment of short-term liabilities. It also helps to ensure that the solvency is business by providing the smooth flow of the production. The next point is the ability to face the crisis. Adequate working capitals helps the firms to face the business crisis, which help in the case of the emergencies such as depressions, natural disasters, earthquakes. Okay, so these are the importance of the working capitals. There are some points of the working capital. The first point is smooth business operations. Second point is the regular supply of raw material. Third point is the easy obtaining the loan. Fourth point is enhanced goodwill. Next, strengthen solvency. And the last one is the ability to face the crisis. Here, these are the importance of the working capital. Here we are revising the concept of a balance sheet. In a balance sheet, there are the two sides, left hand side and the right hand side, liability side and the asset sides, fixed assets and the fixed liabilities. Okay, and in short term, we said the working capital equals to current assets minus current liabilities. Okay, these are the fixed assets. These are the examples of the fixed assets. Fixed assets are those assets which are purchased for the long-term use and are not likely to be converted quickly into the cash, such as the fixed assets are land, building, factories, furniture, and equipments. Here, these are the examples of the fixed assets. Okay. These are the current assets. Current assets means cash and other assets which are expected to be converted to cash within a year. It is in short-term assets. Okay, so examples of the current assets are there. Cash and the cash equivalent. It means cash in hand, cash at bank. Second one is the accounts receivable, which is also called as the bills receivable. Third is the prepaid expenses. Next is the raw materials inventories. Inventories means the stock. But in the working capital, there are considering the three types of the inventories. Stock of raw material, stock of work in progress, and stock of finished goods is covered as the inventory part. The next example is the short-term investment. Here all are the examples of the current assets. Current assets are, it means the cash and cash equivalents, account receivables, prepaid expenses, raw materials, inventory, and the short-term investments. Current liabilities examples. Current liabilities, it means a current liability is a type of liability which is expected to pay within a year. These liabilities are also called as the short-term liabilities. Examples of the current liabilities are cash dividend payables, accrued expenses, which is also called as the outstanding expenses. Next one is the short-term notes payables, considering the bills payables, accounts payables, taxes payables, unearned revenues. So these are the examples of the current liabilities. So the next question is the types of working capital. What are the types of the working capital? So working capital, there are the two types. First is the basic of concept and another one is the basis of time. Basis of concept में another two subtypes, that is the gross working capital and the net working capital. And the basis of time, there are the subtypes permanent working capital and temporary or the variable capital. Temporary or variable capital, another bifurcate is the seasonal working capital or the special working capital. Okay. On the basis of the concept, it means the working capital means that the part of the total assets of the business that change from one form to another form in the ordinary course of the business operations. Here the concepts of the working capital are balance sheet or the traditional concept. Second one is the operating cycle concepts. In a balance sheet concepts, there are the two types of the capitals, working capital. First one is the gross working capital and another one is the net working capital. Here is the concepts of the balance sheet, gross working capital and the net working capital. Gross working capital. In that gross working capital, that is refers to the firm investment in the current assets. Here the investment in current assets like the cash, bills receivable, prepaid expenses and stock. So the investment in the current assets, here the current assets are the assets which is the ordinary course of business. It can be easily converted into the cash, but it is in short period or the normally that is one accounting year or the one financial year. So hence the sum of the current assets is the working capital of the business. So simply gross working capital, it means the investment in current assets and those current assets which is a normal course of the business, which is the smooth function of the business, and it can be easily converted into the cash within a short period. That is a one accounting year. So the sum of the all the current assets like cash, accounts receivable, prepaid expenses, raw material, inventory and short-term investment. All these are the current assets. While we adding all the sum of the current assets, so it's called the gross working capital. Net working capital means net capital working is the difference between the current assets and the current liabilities. Net working capital means the difference between the assets or the liabilities or the excess of total current assets over the total current liabilities. It may be noted that the current liabilities refers to the claim of outsiders which are payable within a short period of normally one accounting year out of the current assets or the income of the business. Net working capital simply that the current assets minus current liabilities and difference between of current assets and current liabilities. Let us clear some example. Suppose the current assets equals to 90,000 and the current liabilities is 40,000. So the net working capital means current assets minus current liability. Here the current assets 90,000 and current liabilities 40,000. So the difference is the 50,000. So the net working capital means 50,000. Temporary or the variable working capital means any amount over and above the permanent level of working capital. Permanent level of the working capital, it means the working capital which is permanent in use. But the temporary or the variable working capital means it vary or the temporary working capital which is required to meet the seasonal demands and some the special emergencies. It keeps on fluctuating from time to time as per the change in the production as well as the sales activities. The requirement of this part of the working capital fluctuated. It varies. Therefore, it should be financed from short-term funds. Variable working capital can be further classified as the seasonal working capital or the specific working capital. Seasonal working capital means some products have seasonal demand. It arises due to the festival. In this way, seasonal working capital maintained to meet the seasonal demand of the product. Specific working capital means which is required to meet the unforeseen contingencies like strikes, floods, wars, etc. Additional working capital is to be arranged to meet the special emergencies. Okay, let us clear the examples or the diagram which is represent to the basis of the time as the temporary working capital or the permanent working capital. Permanent working capital is fixed in the nature And the temporary working capital, it keeps on the fluctuating time to time as per the change in the production or the sales activities. So there's the next concept is the operating cycle, which is also called as the circulating capital or the short-term capital. There's an operating cycle. First, it means a cash is used to buy the raw material. Is used to buy the raw material and the manufacturing expenses, which are incurred to convert the raw material into the semi-finished goods. In that semi-finished goods, then it's converted in the finished goods. Afterwards, it isn't goes on the credit. It means the trade debtors or the bills receivable result. On the receipt of the payment, trade debtors and the bills receivables are converted into the cash, and the cycle of working capital is the completed. So the operating cycle, it means the purchase of raw material. In that purchase of raw material is conversion of raw material into finished products, sale of finished goods products, realization of the account receivables as well as the debtors. So in this lecture, we learned and covered the simple basic concept of working capital and the importance of the working capital. So here I conclude the lecture. In the next lecture, we will meet and learn the more concept of working capital. Till that, take care of yourself. Goodbye.